Why do you prefer to use essentially long-only strategies? Exception made for rare long vol trade. In times of market crashes, you usually stay in cash and not take an even small short position. Am I wrong? You're not wrong. We don't actually short equities in any of our strategies. Like you said, there is the rare exception for long vol. So maybe 2 to 3% of the time, one of our strategies will take long vol positions. But I pulled up a couple of articles that I've done in the past that will illustrate this really well. So the first one is this one, where I talked about what would happen if we shorted the S&P instead of buy long gold in one of our strategies called tactical balanced. So this strategy down here called tactical balanced, this is today's email, by the way. You can see that one of the positions is gold, and this is for extreme high volatility readings. When the market is crashing, it might look big, but this is actually only about a 10% sliver dedicated to the potential for gold. So why wouldn't I short the S&P? Clearly volatility metrics are elevated. Wouldn't that be an awesome time to short the market is essentially the question. Well, I went into this article showing that if I were to have done that, you can see gold did well for me, performed quite well, but short the S&P 500 did horribly. It's actually negative performer. There's actually a very specific reason for that, but I'll pull up another thing that I did. This video here called Short S&P 500 during VIX Futures Backwardation. This video is showing what would happen if the S&P 500 was shorted during VIX Futures Backwardation. And again, remember, VIX Futures Backwardation should be a time when a lot of people would say, yeah, you should short the market, right? Volatility is very elevated. It only happens on about 14 to 16% of trading days. This is actually what happens. Again, negative. That's the same shape of the curve, right? Why is this happening? Well, the reason it's happening, there's actually two reasons. And I named these. This is not like some official name, but the first reason, I call it the slow bleed. And what the slow bleed means is that if you imagine what's happening, when volatility metrics get very elevated, that's the time that you would be jumping into this short S&P 500 position. But oftentimes, unless the market completely falls off a cliff and goes right into a COVID or volpocalypse event, probably that's also right about the time that the market's going to recover. It doesn't always crash off the cliff. European debt crisis, you might have ridden it a little longer. Q4 2018, but these are very rare. Most of the time, when we get into that deep backwardation, the market's going to recover any day now, right? So what you end up doing is you're just walking into these whipsaw events where they're little paper cuts along the way, but it really, really does start to add up. So that's what I call the slow bleed, when you get just constantly hit with that. And then the other thing I call, again, this is just my silly name that I gave it, but I call it the dreaded give back. The second aspect of why this sucks so bad is you can imagine, let's say you really do get one of these awesome spikes. Like this is the financial crisis. This is the European debt crisis, 2011, COVID. You can actually ride short S&P if you get one of those really serious crises. But again, imagine what's going to happen. One of the issues with shorting the market or going long volatility is that those metrics can stay sticky, is what I call them. They can stay very elevated in the 98, 99th percentile for several days or maybe a couple of weeks after the market has already recovered. So the same signals that get you into the short S&P position and you ride it for a little while and you think you're a genius, that's the same signals that keep you in the trade long after the market has already recovered. So you end up again giving back some or perhaps even all of the gains that you made. So that's the dreaded give back. The combination of the slow bleed, you just get these paper cuts over and over again, plus the dreaded give back. Turns out shorting the stock market is extremely difficult and there's really no way to do it. It doesn't really matter how, let's say you only do it 10% of the time, only 5% of the time. It's still the same thing. Most of the time you're walking into whipsaw. So what we do instead with our strategies is I would just prefer to sidestep the crisis rather than risk losing money during a crisis. The last thing in the world you want to do is lose money when you could have just sidestepped to cash. So we go to utilities or cash, totally fine. We're not going to profit from a market crash with this strategy, unless utilities do, which it has in the past. So it's not never, but it's not the actual purpose. Second strategy, gold actually can do well in a crisis. So this one might actually make some money. This one here, there is a long volatility position, but you notice there is no short S&P. And that is the basic reason that essentially you're just walking into a problem there. If you look at my long-term track record for the portfolio for 11 years, the only time volatility metrics has ever really let us down was the first, say, 3 months of 2022. That was not fun at all. Volatility didn't spike early last year, so there really wasn't a way to cycle out into safety. But most of the other times, I would rather just not get killed, right? European debt crisis, I did fine. Here, this is only like a 6% drawdown in the 2015 China scare. Fall apocalypse, we lost nothing. Q4 2018, market was down 20%. We lost nothing. COVID, we lost nothing. I mean, we were in cash during COVID. That's the point. I would much rather just be the type of investor that either does well or tries to sidestep. I don't want to be walking into those constant headwinds of shorting the S&P. It sounds like a really good idea, right? I mean, I'll just wait for the market to crash and then I'll ride this wave and make a bunch of money. But slow bleed plus dreaded give back, you're probably not going to make any money. It's, in my opinion, in my humble opinion, not a wise position to take. That's why we don't do it. Like you said, the occasional long vol, it can work 2 to 3% of the time only. Otherwise, not losing money is also a win in a market crash. Don't ever forget that. There's nothing wrong with cash. So for an extensive volatility metrics dashboard updated daily, and to see all of the live trades for our tactical rotation and option strategies, click this link right here and claim your free trial to the VTS community. You're always welcome to join us anytime. See you next time.